Hey guys, welcome to our next installment of Investercon. Sorry about the slow update rate, but from now on we'll be uploading daily, so stay tuned. Feel free to check out our other videos and drop us a subscribe. We'll be focusing on stocks versus real estate and which one's better today. A long debate between many professional investors has been what's better, stocks or real estate. Both have an argument on which is better, but I personally prefer real estate. It's without a doubt a safer investment overall, but also has a lower ROR, or rate of return, whereas stocks present a much higher risk of your investment but can get a return of 10 to 20% yearly. Personally, I think real estate is the better investment in the long run, and we'll be explaining that in the video. Depending on where you live, the risk factors that are involved in real estate investing can change. For example, take the USA into consideration. They have prime conditions to make it in real estate market, but a country like China is much harder to get there, as the housing prices are much higher and they live in more densely populated areas. Stocks. Investing your money into stocks is one of the most popular forms of investment. The benefits of stocks or shares are that it can be done today, right here, right now. You can go out and buy shares in any major company and your money will become an investment. The downside of stocks is that they're risky, and even though people do say that you can minimize your risk by doing your research, no one can predict the market, so the risk factor will always be there. The bottom line is the stock market prices fluctuate dramatically. So to say stocks will always make you a nice return is a bit naive. While you might make a return of 10% for 10 years, well done, you've doubled your money in 10 years, but what if the market crashes and you lose 50%? Never forget that the stock market is always changing. If you're handling your stocks yourself, you really need to keep on the ball and always keep updated on the current events and what's going on within your company. For this reason, stocks are always seen as a riskier investment. So a little explanation of this. So year one, you invest $10,000. Through year 1 to year 10, you get a rate of return of 10% yearly. So at the end of year 10, you have $20,000. So you've doubled your money, but then on the 11th year, the market crashes and has a loss of 50%, which means you're back to square one with your $10,000 and you've wasted 10 years. This is where the stock market can get you into trouble, as the market drops on an average every 7 years. The odds of you seeing 10 years in a row of growth is pretty slim. If you're learning about the stock market, then you want to get a 5% return yearly. Use this as a starting point and grow your returns from there. The average yearly return on the stock market for the general Joe Blow is about 10%, where professionals can often see returns of 10 to 20% yearly. You've just got to work for it. Does real estate really win? It's not easy as stocks to get into, as it takes a lot more money to start with, more research and more time. For these reasons, many people are turned off by real estate investment, as they think it's too hard. If you do the work, you'll see the reward. Real estate investing can see a lower return and the same amount of risk as stock market if you play your cards wrong. But we're not about that here at Investercon. So here's how you make your money in real estate. The riskiest thing about real estate is the fact that you're playing with other people's money most of the time, unless you buy the house outright. Now, some people say that this is the best thing about real estate, as you're very rarely to lose your own money, as you have invested very little. But if you make a bad deal and the money goes out the window, it's not like the bank's going to say, oh, nah, don't worry about it, we'll cover it, it's fine. They'll come after you and take as much as they can, if not more, than what they gave you in the first place. So basically, you want to buy a house for $300,000 and you put your deposit of 10% on it, or $30,000, and voila, congratulations, you own a house. From here, you can rent this house out for $300 a week, which will lead you to having to wait 25 plus years to see any positive cash flow from the house. However, if you buy a house for $260,000 with a value of $300,000, you will have made $40,000 in house equity in a day. Now, this is classed as a paper asset, as you can touch the money for at least a year. As years pass by, you paid about $15,000 off your house. So now you have $45,000 of equity in your house, which you can get off the bank by refinancing your home. With this newfound money, you can invest in another house and repeat this process. Fun fact, never include your paper assets in your net worth, as it's unreliable and gives the wrong information. It gives you the illusion that you're better off than what you really are, and that isn't good for anyone. So make sure you do your research and come out on top every time. Who wins? This is where real estate beats the stock market, we believe. A house will rarely lose its value, even if the housing market crashes and the value of your property decreases. You'll still have the income that the houses provide, which is the rent, leaving you with a passive income which can't be taken away. The housing market is also much faster at recovering than the stock market, making real estate hands down a better investment of your money. As I said at the start of the video, I believe that real estate is the better investment in the long run. Yes, it does take more to start up in the costs as to buy your house and to get it, but doing it is well worth it. But remember, each to their own, and there'll be people out there that disagree, but that's just the way it is. So weigh it up, see what you think. We believe that housing is the best option. Thank you. There you have it. There's another video done and dusted. Hope you tune in tomorrow for the next update. Be sure to give us any feedback in the comments or via our email in investercon@gmail.com.